Speculation built every major city and destroyed every major bubble. The same act, buying something you do not need, hoping someone else will pay more for it later, is either the engine of economic development or a mechanism of collective destruction, depending entirely on what everyone around you is doing at the same time. That is not a paradox to be resolved. It is the permanent condition of financial markets, and the inability to reliably distinguish productive speculation from destructive speculation before the destruction arrives is one of the central unsolved problems of economic life. Regulators have tried to solve it. Economists have tried to model it. The history of financial markets is largely the history of those attempts failing at the critical moment. Begin with what speculation actually is, stripped of the moral freight the word carries. A speculator buys something not for its current use, but for its expected future price. The wheat farmer who sells a futures contract is transferring price risk to a speculator who is willing to hold that risk in exchange for the potential gain if prices move favorably. The venture capitalist who funds a startup is speculating that the company will be worth more in 10 years. The person who buys a house in a growing city is speculating that the city will continue growing. None of these activities is inherently destructive. Several are genuinely productive. The case for tolerating and even encouraging speculation in financial markets rests on two functions that speculation genuinely performs. The first is liquidity. Markets require buyers and sellers willing to transact at close to any given time, without speculators willing to take the other side of a trade. To buy when farmers want to sell futures, to sell when investors want to buy, markets become illiquid, prices become volatile, and the legitimate hedging function of financial markets breaks down. Speculation provides the counterparty that makes hedging possible. The second function is price discovery. Speculators who gather information about the likely future value of assets and trade on that information cause prices to reflect that information. The commodity speculator who correctly anticipates a drought and buys grain futures is not predicting the drought into existence. They are incorporating information about it into the price before it arrives, which causes market participants to adjust their behavior, storing more grain, planting alternative crops, adjusting consumption earlier than they otherwise would. The speculation produces a social benefit that the speculator did not intend. Both functions are real. Both justify the existence of speculative activity in financial markets. The genuine case for speculation is not a rationalization invented by those who profit from it. It is grounded in mechanisms that work, now hold the counter-argument at full strength. Because it is equally grounded. John Maynard Keynes, writing in 1936, made an observation that has not been improved upon in the decades since. He described professional investment as a beauty contest, in which the goal is not to identify the most beautiful contestant, but to identify which contestant the other judges will vote for. The successful investor on this account is not trying to assess the fundamental value of an asset. They are trying to assess what other investors will believe about what yet other investors will believe about the asset's value. The chain of inference recedes from reality. The price becomes untethered from the underlying thing it supposedly represents. This is not a theoretical possibility. It is the documented behavior of financial markets during speculative episodes. The Dutch tulip mania of the 1630s, the South Sea bubble of 1720, the railway mania of the 1840s, the dot-com bubble of the late 1990s, the US housing bubble of the 2000s. In each case, prices rose far beyond any defensible estimate of fundamental value, and sophisticated participants knew this and continued buying, because the momentum of other buyers made continued price increases self-fulfilling until the moment they were not. The speculator who believes tulip prices will double in a month may be entirely correct, even if tulip prices are already 10 times what any use value justifies, because enough other speculators share the belief. The belief creates the reality until it creates the ruin. Keynes also noted that as financial markets develop and deepen, the speculative function, trading on expectations about other traders' expectations, tends to grow relative to the enterprise function, allocating capital to productive investment based on assessment of underlying value. The casino grows relative to the business it supposedly serves, And at some point, the relationship inverts. The business becomes an adjunct of the casino rather than the other way around. Here is the floor move. Speculation has metastasized into the real economy in ways that directly determine the material conditions of ordinary lives. Housing is the clearest case. Housing is simultaneously a basic human need, shelter, and a financial asset, property. These two natures coexist in every house, in every apartment, in every square meter of urban land. The tension between them is manageable when housing prices track income growth roughly. When housing becomes primarily a speculative asset, when people buy properties not primarily to live in them but primarily to sell at higher prices, the two natures come into destructive conflict. Prices rise not because the shelter function has improved, but because the asset function has attracted capital-seeking returns. The person who needs shelter experiences the price increase as the rising cost of a necessity. The investor experiences it as a return on investment. The same number produces opposite experiences depending on which side of ownership you are on. In the decade following 2010, low interest rates globally pushed capital toward yield. Residential property in major cities became an asset class attractive to institutional investors, sovereign wealth funds, and high net worth individuals seeking returns. Foreign capital flowed into housing markets in London, Sydney, New York, and dozens of other cities, bidding prices upward. The housing stock did not grow proportionally. The population needing shelter did not shrink. Prices rose because demand from speculative investors outweighed the supply of units, and the speculative demand had nothing to do with anyone's need for a place to live. Families were priced out of the cities where work was available. People with stable employment, graduate degrees, and what previous generations would have considered solid middle-class incomes found themselves permanently renting in cities where home ownership had defined the middle class for 50 years. The wealth effect ran in reverse for them. The rising asset prices that enriched those who already owned impoverished those who did not by raising the entry price of ownership to levels that could not be reached through wages alone. The speculation inflicting real cost on real people who have no participation in the speculative activity causing it. The cause and the cost are borne by different people. The person earning the return and the person out of shelter are not in a transaction together. They are not negotiating. They are occupying the same market, but from positions so different that the market's behavior serves one by harming the other. Whether this outcome was the intended consequence of the policies that enabled it, low interest rates, limited housing supply, permissive treatment of property investment by foreign capital, is genuinely contested. Central banks that maintained low rates after 2008 were responding to real deflationary pressures and genuine economic fragility. That their policies would channel capital into housing speculation and produce affordability crises in major cities was probably understood as a risk. It was weighted against the alternative risks is not publicly documented. The outcome was foreseeable. Whether it was foreseen and accepted or simply not adequately anticipated is harder to determine from outside the deliberations. Now look at the broader political economy of financial speculation. Who benefits from the tolerance of it at scale? The financial sector is the primary beneficiary. Transaction volume, the total value of financial trades executed, generates fees, spreads, and commissions regardless of whether the underlying activity is productive. $1 trillion of real investment in productive assets generates different fees than $1 trillion of speculative trading in derivative contracts, but both generate revenue for financial intermediaries. The financial sector has a structural interest in high levels of market activity, and speculative activity drives volume. This interest expresses itself in lobbying against regulations that would restrict speculative activity, position limits on commodity futures, Tobin taxes on financial transactions, restrictions on high-frequency trading, not because those regulations would necessarily harm the real economy, but because they would reduce transaction volume, and therefore revenue. The wealthy investor is the secondary beneficiary. Speculative activity in asset markets tends to inflate asset prices, stocks, property, commodities that are disproportionately held by those with existing wealth. The inflation of asset prices driven by speculative capital flows enriches those who hold assets and widens the gap between them and those who hold primarily labor income. This connection between speculative activity and the concentration of wealth runs through the inequality statistics of the last 40 years without being consistently named in the debates about those statistics. The ordinary worker and the person without assets bears the cost when speculation crosses into bubble territory, and when the bubble collapses, they bear it as the unemployment of the recession that follows the crash. They bear it as the housing costs of the speculation-driven price increase. They bear it as the pension fund losses when speculative vehicles fail. They did not make the bets. They absorb the consequences of others' bets. The asymmetry is the same one we identified when we looked at risk. There is one dimension of speculation that is rarely examined honestly in either direction. Venture capital, the speculative funding of early-stage companies by investors who expect most investments to fail and a small number to generate extraordinary returns, has funded a significant portion of the technological innovation of the last 50 years. The structure is genuinely speculative. The investor does not know which companies will succeed. Most will not. The portfolio bet is that the returns from the few that do will exceed the losses from the many that do not. And the system, within specific conditions, has produced real companies that provide real services. The counter-argument to that observation is that the same structure also funded much that did not need funding, valued companies at multiples disconnected from underlying economics for years, produced enormous paper wealth that concentrated in the hands of founders and early investors, and created the technology monopolies we examined when we looked at competition. The question of whether the innovation produced by venture capital speculation was worth the costs, in monopoly concentration, in wealth distribution, in the speculative culture that inflated and then deflated multiple technology bubbles, is genuinely open. A confident answer in either direction requires more certainty than the evidence supports. Now bring this into your actual life, into the specific financial decisions that face you. Every time you make a purchase on the assumption that it will be worth more later, a house, a financial asset, a collectible, a cryptocurrency, you are speculating. Not in the pejorative sense, in the precise sense. You are making a bet on future price. The bet may be well informed, it may be based on genuine analysis of underlying value, it may even be correct. The question worth sitting with is simpler than whether the bet is correct. It is whether you know what kind of bet you are making. Whether you know the difference between a price that reflects something real about an asset's capacity to produce value and a price that reflects what you believe others will pay. Whether the thing you're buying is serving the function you believe it is serving, or whether you are in the beauty contest, choosing the contestant you think others will vote for, without having noticed that you entered it. Financial decisions made inside a speculative fever feel different from outside one. Inside, the rising price is evidence that you were right. Outside, it can look like evidence that the price had become untethered from anything except the momentum of other buyers. The difficulty is that you are always inside. There is no observation deck.